Dear students, the topic we are going to discuss today is about interest rates in India. In this session, we will discuss about what is interest, what are the type of interest and interest rates, and what are the factor which affects interest rate, helps in determining the interest rate and causes the changes in interest rate across the globe. We will also discuss about various type of interest rate and their impact on economy. As we know that interest is the key factor which affects the monetary supply into the market. Higher the interest rate, lower would be the supply into the market, and hence it will affect the investment into the market would be lower. Let us begin our session. The definition of interest. In general sense, we know that interest is the amount paid by a debtor to the creditor for the use of his money. Various economists has defined interest in a different manner. As per Professor Marshall, interest is the price for use of capital in any market. That means the cost or the price of the money utilization is known as interest. As per Professor James Keynes, interest is the reward for sacrifice of liquidity for a certain period. Keynes believes that everybody wants certain extent of liquidity in his hand. While lending that money to the borrower, he has to sacrifice that comfort of liquidity, and somebody who is taking that money has to repay more money than the principal amount as the reward of the sacrifice done by the creditor. Lipse has defined interest as payment given for use of money, and Seligman has defined interest is the income received in return of some capital fund. On the analysis of all the definitions, we can conclude that interest is the part of national income which is paid to the capitalist in form of rewards for use of capital. This definition is for the broader aspect of economy, where entire domestic production has been taken into the consideration and the money has been divided into the two parts, where one section is a creditor and another section is a debtor, and the part of the national income which the creditor receives is known as interest. Interest can be divided into two types. First is net interest and second is gross interest. Net interest is the amount which the capitalist gets as reward only for use of his capital, but the gross interest is a combination of net interest plus reward for risk, reward for inconvenience and reward for management. As the process of giving the money to someone for a certain time period requires a process of accountancy or management, it has a inconvenience and loss of opportunity, and also it covers the risk loss of money forever. When the gross interest is computed, then all these factors are taken into consideration. Hence, gross interest become a bigger amount than the net interest, but net interest is the actual reward received by the creditor. This interest is computed or is paid as per the rate of interest. Rate of interest is defined as the rate which is expressed on annual basis per 100 in the form of reward for use of capital. If you take the example, then if somebody says 10% per annum interest rate, then it means that if a person has taken loan of 100 rupees from another person, then after year he has to pay 110 rupees. The 10 rupees additional paid by him would be the interest, and the 10% is the rate of interest. Interest is a very old phenomena of global economics. It started in Middle East countries where they had a concept of food money. They believed that as food grains can produce more food grains, livestock can produce more livestock in future. The same way the money has a tendency to multiply itself. So, whenever they used to take money from someone else for their day to day requirement, they used to pay higher money as per the terms and conditions pre-decided. From that era to the modern era, interest has seen several changes. If we see across the globe, then we find the different practices in interest. There are the countries which has completely abandoned the interest on the religious ground like Saudi Arabia, Pakistan, Iran, etc. Most of the countries are practicing different interest rates. This interest rate varies from the negative to almost 800%, where the Swiss bank charges or pays negative interest rate on the deposits. On the other hand, Central Bank of Zimbabwe has put 800% interest rate as a basic loan rate. This huge variation of interest rate across the globe is due to the various reasons. Let us analyze what are the factors which cause the difference in the rate of interest across the globe. First cause is difference in business risk. As we learned in the gross interest, business risk was one of the key factor which was adding into the net interest. If a business has a lower risk, then the lender or the creditor feels safe and he charges a lesser interest rate. On the other hand, when the business is risky, the interest rate would be higher. Difference in personal risk. Every individual carries a different goodwill and a different risk profile. As per the difference of the institution, a nation or an individual person, this risk profile changes. Creditor feels safer to lend the money to the particular borrower as per the personal risk profile of that individual or an organization. He gives the loan on a lower interest rate, and in case when he is not comfortable with the risk profile of the borrower, the interest rate goes higher side. Debt period. Debt period is a key factor to affect the rate of interest. Longer the period of loan, it has a tendency to be charged of a higher interest rate, as in the longer period the money would be devalued due to the inflation, and once inflation is taken into the consideration, it increases the rate of interest on the longer period of time. Difference in distances. The world is becoming a global village. The people are taking loan from their own neighborhood to the different nations across the country, but longer the distance between the creditor and borrower, inconvenience and risk profile increases. It has a tendency of human being to give the loan on higher interest rate the different people who are staying abroad or far off from their geographical location. Even the Bank of Japan, which gives loan on 2 to 3%, and the domestic borrowers, they provide the loan on 6 to 7% on the international borrowers. Interest rate is always affected with the demand and supply of money. Once the international fund is flowing into the country, then increase the supply of money into the country, and which will eventually result into lowering down the interest rate. On the other hand, once the money is moving out or going to the different countries, then it has tendency to increase the interest rate. Security against debt. Once the loan is secured, a proper mortgage or hypothecation is made against the loan, then lender or the creditor feels safer and he tends to charge lower interest rate. And in case when loan is completely unsecured or there is no money, no asset has been hypothecated or given as a mortgage, then interest rate would be on higher side. Economic conditions. Economic condition of any country or a geography also determines the rate of interest. Once the economy is facing the depression, then the people are not going for the investment and hence it reduces the interest rate. If there is economic boom and then the new investments are happening very fast, people are putting their money on the stock market and economy is growing on the rapid growth, then interest rate is charged higher. Difference in inconvenience, difference in objective. Both the topics covers the same. Once the borrower has a different objective like personal usage or utilization of that money for the purpose which are not going to reproduce more money, then the interest rate charge on them would be higher. Productivity of capital. If the money is being put into the area which are higher risk and higher reward area and the productivity out of those area would be higher, then administered interest rate or the market interest rate is higher, and the areas which has a lower productivity but essential for the economy, then the government ensures a lower interest rate as a administered interest rate for those areas. Difference in economic development. It has been observed that economically developed countries has a lower requirement of the capital. Once on the other hand, the developing and the least developed countries has a higher requirement of the capital. That is why countries like Japan and USA has very low interest rate. Their interest rate over there is almost 2 to 3%, whereas the countries like India or the China has interest rate almost in 6 to 10%. Even it has been observed that sometimes the developed countries has kept their interest rate higher and delivered a good economic growth rate. Like in the era of Margaret Thatcher, United Kingdom has kept interest rate very high and still they delivered a very high economic growth. It is also observed that once the interest rate is very low, then the money supply increases. People put more money in the real estate and it also creates economic bubble, like what happened in 1980s and 1990s in Japan, where interest rate was quite low, or it is claimed by economists that it was kept artificially lower. It resulted into a high economic growth in real estate era. Longer run, it converted into a high inflation and a bubble burst in Japan. Difference in banking facility is another cause which affects the change in interest rate. Where the banking facility is proper in a particular geography, then the higher deposits would be there and the banks would be easily able to make credit available for the borrowers. Once the banking facilities are not proper in any geography or in any country, then the borrower faces problem in finding the right institute to give money to him, and hence they have to pay higher interest rate. Difference in mobility of capital, trade condition and differences in political condition are also relevant to the convenience of the creditor. Stability in a political scenario, stability in a trade and the easy mobilization of capital gives the ease and reduces the interest rate, and the reverse of it will increase the rate of interest. We have learned about what are the factors which causes the change in interest rate. Let us learn about some factors which actually helps in determining the rate of interest. The interest rate in any geography is determined by demand and supply of credit, central bank policy, bank cost and non-performing asset. Demand and supply of a credit is the key factor to establish the interest rate. In market oriented interest rate, the demand and supply is the only factor. Higher the demand of the money, higher the interest rate would be. Lower the demand or higher the supply of money will ensure lower interest rate into the market. Central bank policy is the key factor to determine rate of interest once administrated interest rate is prevailing in the economy. Central bank determines the rate of interest by the various tools like statutory liquidity ratio, cash reserve ratio, reserve repo rate, etc. By all these tools, central bank ensures the certain supply of capital into the market. Once they increase the supply into the market, the supply demand law works and higher supply ensures lower interest rate. And if they reduces the supply of capital into the market by utilization of their economic tools, then interest rate tends to go higher. Bank cost. As in the gross interest rate, we learned about cost of inconvenience. Bank cost. As in the gross interest rate, we learned about the factor of cost of management. Bank cost is a similar factor. Bank has to manage their own expenses out of the credit given to the borrowers. Like we learned in the gross interest what the cost of management. In India, saving bank accounts has almost 13 lakh crore rupees as a deposit and current accounts has almost 4.5 lakh rupees as a deposit. To manage all this fund, bank has to make certain expenses on the branch operations, on their employees, etc. These all the factors are considered before setting up the bank rate of interest, and that is why this saving bank account interest rate has been kept deliberately low for the several years in India, as the various banks has claimed to the Reserve Bank of India that their expenses on the maintenance of saving bank account are very high, and that result into the Reserve Bank gave them the permission to keep the saving bank account interest rate to 3 to 4%. Recently, Reserve Bank of India has said that the cost claimed by the bank for the maintenance of saving bank account is reducing due to the various technology like ATM and online banking, etc. By the reduction of this interest rate, Reserve Bank of India has made it clear that every bank has its freedom to offer the different saving bank interest rate for their account holders. Non-performing asset is another factor which determines their interest rate. Once banks are giving the loan, they have also risk of losing that money forever in case of the bankruptcy of the borrower. The factor of the cost of risk is similar to the non-performing asset, and to recover that non-performing assets loss and to cross subsidize that loss, banks kept that extra interest rate to the honest borrowers. Various interest rates in India. In India, we practice two types of interest rates. First is administrated interest rate and second is market oriented interest rate. Administered interest rate, as the word itself is very clear that this interest rate is being administrated, is defined as interest rates which are administered or regulated by the Reserve Bank of India are known as administered interest rate. These rates are like repo rate, reverse repo rate, bank rate, interest rate on employee provident fund and public provident fund, etc. Let us discuss them in detail. First is bank rate. Bank rate is the rate at which central bank of the country allows finance to commercial banks. This is a tool for the Reserve Bank of India for short term purposes. This is also known as a base rate or lending rate. This administered interest rate has its own pros and cons. The shortcomings of administered interest rates are very low and irrational interest rates on deposits. Especially in the saving bank accounts, we are getting only 3 to 3.5% rate of interest, and on the current account the interest rate paid by them is 0. And also the interest rate on the term deposit for longer than 3 to 5 years, there is no change, or even lower interest rate is offered for the longer term of term deposit. Technically, it should happen that longer the term of the term deposit, higher the interest rate should be paid to overcome the fear of inflation. But the banks are not allowed to offer that interest rate for the long term deposit because it has been administrated and regulated by the Reserve Bank of India, and they cannot offer more interest rate on term deposit for 3 to 5 years, and higher than that will not fetch any kind of advantage on interest rate. Negative effect of differential rate of interest on banks' profitability. The several different projects controlled by the government has different rate of interest, like ceiling of interest rate for the agriculture purpose is 9%. No bank can give the loan to the farmers on higher than 9% up to 50,000 rupees credit. Also, the priority sector, poor, BPL also get advantage of the government policies for the lower interest rate. Due to all these kind of controls, the bank's profitability got affected. Low interest rate on short term treasury deposits. Any kind of deposit which is there for the 30 days to 180 days or 365 days, interest rate offered by the government is 3% to 4%, which is as good as interest rate offered on the saving bank account, and that is why this treasury deposit are not attractive in the investors. High prime lending rate. Reserve Bank of India controls the prime lending rate by cash reserve ratio, statutory liquidity ratio and repo rate. Once the government keeps the SLR and CRR higher, the most of the money of the banks are parked with the Reserve Bank of India. So, they have to manage with the remaining capital with them. If the cash reserve ratio is 10%, then the 10% of entire capital of saving bank account plus current account and term deposit would be parked with Reserve Bank of India, and bank has to operate and make profit out of their 90% of remaining fund. Thus, this administrated prime lending rate causes a higher side, and the borrowers get loan on a very high interest rate, and it makes a negative impact on economy. Investments get reduces and opportunity for the economic growth also reduces. Redetermination of administered interest rates is also another drawback of administered interest rate, because it is not being determined by the market operations or the requirement of market, but it has been determined by the Central Bank of India, which follows the monetary policies and fiscal policies or the broadly on the objective of the government of India. Last shortcoming of administered interest rate is a redetermination of administered interest rate. These rates are determined as per the objective of the government, and it has no connection with the reality of the requirement of the market, and thus many times market got disappointed due to the administered interest rates. Let us summarize our session on interest rates in India. In our session today, we discussed about the definition of interest and interest rates, the type of interest rates and type of interest, and we discussed in detail about the factors which causes the changes in interest rates across the globe. We discussed about the two types of interest rate, and we discussed the shortcomings of administered interest rate. The next session we will discuss in detail about the types of administered interest rates and market operated interest rates. Thank you.